In this video, we cover short and long-term market technicals. Do they favor higher highs in stocks, or do they favor lower lows? We also outline some potential holes in the recent EU bailout plan. After the close on Friday, which was here, we'll have to see what Monday brings, but there seems to be a good chance that Monday would be a down day and that we might go into some type of reversal here. Again, we'll have to see what next week brings. What we're looking at here is the S&P 500 index. It's a daily chart. And what we want to look at here, this date right here, July 21st, is when the previous all-encompassing last solution to take the problems in Europe off the table was announced on July 21st. We had a strong up day on good volume. This candlestick shows strong buying pressure. The wick at the top says that we closed off the daily high. The following day, this candlestick shows indecision. So this cross up here says that the bulls and bears really were somewhat equal during the day. There wasn't necessarily strong buying pressure or strong selling pressure. And you can see that we ended up closing relatively close to the highs. So this candlestick and this candlestick look very similar to Thursday, when the most recent all-encompassing and final and complete solution for Europe was announced. This is a long candlestick showing a lot of buying pressure. This wick tells you that we closed off the high, and this is a very indecisive trading session on Friday. This is respectable volume. This is much lower volume. At the end of today's video and in today's short takes, we'll cover some reasons why the market might have been indecisive here and some reasons relative to the latest bailout plan that might cause potentially a sell-off. We'll also discuss in this video breadth. We're at a point where a breadth surge says that we're probably either going to go sharply higher or sharply lower in the next 1 to 2 weeks. One more point before we leave this chart. It's possible, since this is such a strong move, that even if we get a pullback here, we may get somewhat of a retest up here. So this is indecision, so maybe you get a sell-off, indecision. If you come up here, the indicators would probably either be strong or weak. So what you look for here, if we happen to come down and then go back up, if you see non-confirmation and a weak MACD, a weak RSI, that tells you don't be too concerned about this. If you're a bear or if you're a bull, this is probably a false move, as this was. And if you did look at the indicators here on this bounce, this was an extremely weak move before we got this. So are we in a situation here if next week is bearish, and we'll just have to see what happens next week? If it is bearish, we could go down, come back up, and then go down. Now let's take a look at volume short term. What's that telling us? Here's the candlesticks from July. Here's the candlesticks from Thursday and Friday's session. In July, on this day, you got respectable volume on SPY, the S&P 500 spider. This day here, where the market was indecisive, this day came on weak volume. This is about a 49% drop in volume between this day and this day. Low volume also aligns with indecisiveness, which is often followed by weakness. Similar, high volume day here. On the indecisive day here, we had about a 43% drop in volume. So the volume situations were similar here, and here we got weakness following this period in July. We may get weakness next week. Like a lot of the things we look at in videos, this looks very complex. It's not all that complex. We've seen a lot of commentary and been asked some questions lately about what are known as breadth thrusts. This is the McClellan oscillator here. What this measures basically, or what it's based on, is the number of stocks that are participating in a rally, so advancing stocks minus declining stocks. So this is net, based on net advancers minus net decliners. Why do we care about that? If a market's moving higher and you have broad participation, so a high percentage of stocks participating in the rally, that tends to be a healthy rally and sustainable rally. If you have a low percentage of stocks participating, so your advancers minus decliners would indicate weakness, that shows a rally that's probably not sustainable. So what are we looking at here? What we're looking at here, this is a breadth indicator here. So this is strong breadth, this is weak breadth. Down here is the S&P 500 index. This is 2008, 2009. This line here shows you what this breadth indicator hit recently. It recently hit 93.06, which is this blue line here. A lot of commentary would tell you that the fact that we hit this, we had a breadth thrust, and that's bullish. And that can be true. But what's important is it can also be bearish. So let's look at some things here, and then let's tie in some other charts from this period and show some divergences, non-confirmations, both bearish and bullish, and try to get a read on the fact that this indicator hit 93.06 in October of 2011. Does that lean bullish or bearish? So what we've got here is, here's a similar reading to what we've had in October of 2011 that occurred in November of 2008. We got another one here, a similar reading to what we've seen recently early in January of 2009. And again, this is the S&P 500. And a third one came in March of 2009. And here was the bottom for the bear market. Takeaway. Just because this is a binary indicator is the takeaway here. This can indicate an overbought market that's about to decline again, an overbought market that's about to decline again, or a positive breadth thrust that is actually bullish. So if you took this indicator in isolation in the last bear market and you read this reading as being potentially bullish, this is what happened. 1 week later, the stock market was down 10%. 3 months later, it was down 17%. Similarly, if you read this breadth thrust as being bullish in early 2009 instead of being overbought, about a week after this period here, we were down about 4.5%. And 8 weeks later, the S&P 500 was down 24%. Now, it is true that a high reading on this indicator can be bullish. Here, we got a similar reading. Many people probably said this means the market's overbought and it's about to go down. At the start of a new trend, a high reading on this can be bullish. And here's March 18th, 2009 is when we got a similar reading to what we've seen recently. And these numbers indicate here that it is bullish. Market went up, 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 up. What we've calculated here is just the risk-reward ratio of these three readings. So you're potentially late in a cycle, in a bear market, and you get a reading here, a reading here, and a reading here. The risk-reward ratio of these three readings is horrible. You'd like to see a risk-reward ratio come in to be about 3 or greater. Anything under 1 is negative. You can see these are all under 1. And what it tells you is that reading this indicator here, which is similar to the present day, may not necessarily be bullish. It's binary. It tells us that in the present day, the stock market is probably going to move sharply higher or continue a trend higher as it did here, or it's going to move sharply lower. Our read is that the odds probably still favor similar outcomes to this. However, If the stock market shows much more strength next week or over the next 2 weeks, it may start to lean towards these outcomes. But again, we believe that this recent reading on this is leaning in this direction still, but we're going to have to see what happens in the next 2 weeks. All right, let's set the stage here. This is what we just looked at. This is the breadth indicators, and what we're trying to determine is the recent reading that we got, this blue line, is it similar to this, or is it similar to this? And what we're going to do now is we're going to look at, this is another thing that looks complex. It's not complex. This is the S&P 500. It's a weekly chart. This is price. This is the end of the .com bear market. So there's the bear market bottom there. Came up, made a higher low, and eventually stocks moved higher. Takeaway here is sharp declines tend to end on a weekly chart when you get bullish divergences. So let's talk about bullish and bearish divergences, maybe some things to look for in the present day to help us determine when we might have put in a final bottom. You can see here, this is price, S&P 500, 2003 out here, 2002 here. Price makes a sharply lower low here. These are indicators. This is the commodity channel index. This is the MACD histogram. You don't really need to know anything about these indicators, but you need to know that divergences and confirmations with price can help us. Lower low in price, lower low in the indicator. What that tells you is it's a confirmation of this move. Lower low in price, lower low in MACD. What you get out of that is it says this is probably not your final low because this is confirming this move lower. So you get a bounce here. Everybody gets all excited. The bear market's over. It's time to get in. The bears are getting cremated. But you've still got to come in and make a lower low. And you'll see here when we made the final low, this is price, there were now bullish divergences. Price makes a lower low. The indicator clearly makes a higher low. Lower low, higher low. And this actually was your final low. And even that's not easy because if you bought here, you feel good for a while. The market comes all the way back down to this level to scare the bejesus out of you. But this was the final low, and this was the time to buy here. We're going to compare that to the present day. We've got more charts here that look very complex and busy. Concepts are not difficult. This is the breadth indicators that we've looked at. What we're trying to determine here is, does the present day look like this, which was a bearish overbought reading, or this bearish overbought reading, or this bullish breadth thrust reading? This is the end of the last bear market. 2008 is here. 2009 is here. Same thing that we just looked at. This is a weekly chart of the S&P 500. You've got a lower low. Indicator confirms the lower low by making a lower low. Lower low in price. Indicator confirms the lower low by making a lower low. What these indicators are telling you is this is probably not the final low. And this is probably a false rally where everybody says the bear market's over. The bulls feel good here. The bears are getting cremated here. But these confirmations here are really still siding with the bearish case. What we're trying to do is tie these breadth thrusts into these confirmations and divergences. Price eventually came down in March of 2009. Price makes a lower low. And you've got a clear bullish divergence here, telling you that the risk reward of buying here is much, much better than buying here. Price makes a lower low. Indicator clearly bullish, again saying this may be a good entry point. A comment about these confirmations and divergences: obviously they don't work all the time. They tend to be good signals, especially on a weekly chart. Any kind of confirmation or divergence is much, much more meaningful on a weekly chart than it is on a daily chart. Similarly, on a monthly chart is more important than a weekly chart. Takeaways here. You could have read this breadth thrust, which is very similar. This blue line is the breadth thrust that we've seen in 2011. You could have read this as a bullish breadth thrust. If you did that, that's this point right here, you did that in an area where you didn't have any kind of bearish or bullish, I should say bullish divergences. So you had the thrust here, bad signal. This would have been a bad signal if you read it as bullish. Stocks went down, made lower lows. Got this breadth thrust here, similar to what we have here. If you read that as bullish, that was a bad read. We went lower. The third one was a good read. What we would look for is you would want this breadth thrust that's just similar to what we've seen in October of 2011, which is this blue line, the reading that we got. You'd like this to be confirmed on the charts. This could be read as a positive breadth thrust. Why? Because when price came down, when you got this thrust here, you had bullish, clear bullish divergences. Let's see what we've got today. So we've got a reading similar to these three readings in terms of breadth. The problem is, relative to last summer, we made a higher low. So this is the S&P 500. This is 2010. This is 2011. We've made a higher low in 2011, but we've got huge bearish divergences, giant ones, between this low and this low. MACD, this is a higher low, lower low, lower low. So what does that mean based upon what we've seen from the last two bear markets? What it's telling you is this bearish divergence and this bearish divergence says that this is probably not the final low. This is probably a false rally where the bears feel miserable, the bulls feel good. This tells you that the odds are that the current read of a breadth thrust is probably more like one of these two rather than this one. And if you remember, I'll go back and look at the risk-reward chart, stocks dropped quickly and rapidly from basically this point here. So our read based upon these weekly charts and many other things is that the current breadth thrust probably looks more like these two, which is bearish. Here's where the thrust took place. Stocks eventually made lower lows rather than this one. We're going to have to see what happens. There's no question that the bullish case has gained some ground recently, but I don't believe that it has overtaken the bearish case yet. Let's close with some points about fundamentals. Right now, fundamentals, the most important thing in the markets is and will continue to be Europe. It's more important than any GDP number in the United States, any economic outlook. It's more important than earnings. It's the biggest issue. Why? Because it's a serious, serious problem that could take down the economy in Europe and take down the global economy. This potentially is a problem that's bigger than Lehman Brothers. So we have to take it very, very seriously. Why, fundamentally, might the market be skeptical about the announcement that was made last Thursday that caused stocks to skyrocket? Just a few comments here. The bank recapitalization plan is weak. The headline number that they announced is not really the money that the banks are going to have to go out and raise capital to meet that number. In fact, some analysts believe that they're only going to have to raise about 1/10 of what was announced. And why is that? Well, they're doing some double counting. They're including bank recapitalization numbers that they've already announced to the market. So the number they announced on Thursday isn't in addition to, it includes previous announcements. So they're doing a little double counting there. The banks also are going to be allowed to do some rearranging on their balance sheets, some accounting tricks basically to make them look like they're more stable. And they're going to be able to use retained earnings or cut dividends. So in terms of new capital being pumped into the banks, could be about 1/10 of what was announced last Thursday. Another concern would be with the stability fund. It's a little ironic that the indebted members of the EU all have to contribute to the European Stability Fund. They're contributing to the fund, yet they're indebted and having trouble balancing their books. So what good does it do to have Italy contribute to the fund and then have the fund come back and bail out Italy? It's somewhat of a circular logic where everybody bails out everybody. If you and I are broke, I can't bail you out and you can't bail me out. It's also a problem for a country like France to contribute too much into the fund because their AAA rating may be at risk. The leverage that they're going to use with the fund, which, again, ironically, leverage was used in the mortgage market in the United States, and the Europeans have bashed us for that, and now they're running into trouble, and they're going to leverage their fund and do similar things to what we did here in the United States in the mortgage market. The problem with the leverage is they're thinking of using about a 20% insurance against losses. And what does that mean? It means if I go buy a new Italian bond at a bond auction, the European Stability Fund might cover me for the first 20% of the losses. The problem with that is if you understand the history of sovereign debt defaults, let's use Greece as an example. Greece recently defaulted. No matter what anybody tells you, they defaulted. If you had a bond, they're only going to pay you 50 cents on the dollar. That's a default. The point is that's a 50% default. So typically, you get a large write-down or default on a sovereign bond, not something small like 20%. So if they're going to protect me against 20% of losses and I get a 50% loss, that's really not that impressive. Lastly, until the specifics of the European Stability Fund are nailed down, the details, Thursday was somewhat high on rhetoric, high on outline, high on concepts from Europe, and very low on details of how they're actually going to implement this and pull it off. Until those details are nailed down, and it may take weeks, really months in some cases with the leverage, until they do that, it's going to be very difficult to go out to a country like a China or a Brazil and ask them to pump money into the fund. In fact, China came out on Saturday in a commentary and said that don't expect us to bail you out. And until there's specifics with the plan, it's going to be very difficult for them to get any commitments from a China or a Brazil. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Ciovacco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.